This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in to the Planet MicroCap Podcast. You can follow the podcast on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you are listening to episode 24. For this episode of the Planet MicroCap Podcast, I spoke with Sam Namiri, associate at Grand Slam Asset Management. I've met Sam at many microcap conferences over the years, and we would exchange ideas about what is going on in the microcap market. I thought it would be informative to do an interview with Sam and share with all of you what I've learned in my conversations with him. In this interview, we discuss Sam's microcap investing strategy and how that's evolved since he started at lunchtime in high school. Specifically, what I thought was very interesting for this interview, and the goal for this episode, is to understand how to value a microcap stock according to Sam. Thank you again for tuning in to episode 24 of the Planet MicroCap Podcast. Please enjoy my interview with Sam Namiri, but first, a word from our sponsor.
A comprehensive streaming of market data, research, and portfolio management application for you. QuoteStream is a real-time streaming quotes and research system designed for the day trader, retail investor, institutional investor, both new and old. QuoteStream offers low latency, tick-by-tick data, advanced charting, comprehensive technical analysis, news, and research. With no software to install and no servers to maintain, QuoteStream is the ideal solution for you. Go to stocknewsnow.com and start your free 7-day trial. Click the QuoteStream banner in the header or real-time quotes in the nav bar to get started building and managing your investments.
For this episode of the Planet MicroCap Podcast, I have Sam Namiri, associate at Grand Slam Asset Management, on the program. Sam, welcome to the Planet MicroCap Podcast.
Thanks for having me, Robert.
It's my pleasure. Thank you for coming on. So, to start off, as we do in every episode, I want to know, what is your background and how did you get into microcap investing?
Okay, so I guess microcap investing even precedes my background, so I'll start off there. When I was in high school, me and another guest you've had on the show, Chris Lahiji, we went to high school together, and during our lunch breaks, we would go on the computer and dial up our internet and go on Yahoo Finance. And, we were just always interested in different stocks, which at the time was, the late 90s tech bubble. And so we would always try to find, the next tech company that would, go up 50 times, 100 times. And that's how I got into microcap investing originally. And I guess after that, I went to college at Berkeley, studied engineering. I had a jewelry company afterwards that I founded and ran. Eventually I went to business school and ended up now at a hedge fund called Grand Slam Asset Management.
And so, how do you go about investing in microcap stocks? What is your strategy? I mean, you've been doing it a while now.
Yeah, my strategy's evolved quite a bit since, back in my high school days. And what changed for me a lot was I would invest in stocks and they would come out and beat earnings numbers, for instance, what was projected. And the stock would, for some reason go down even after beating earnings. And I realized that, maybe I'm not understanding certain things in terms of valuing a stock. And so for me, when I went to business school, the main thing that I tried to learn and understand was valuation and how to come up with a good valuation. And I went to Columbia Business School, and they're known for their value investing program. And, I took a lot of classes with a lot of professors who, themselves are active hedge fund managers. And that was one of my focuses was not only just valuation, but also, trying to understand what makes a business good and what makes a strong business. And so when I look at a microcap company, there's three general questions that I ask myself. The first question is, do I like the business? Do I think it's a good business? that's obviously quite qualitative in terms of how you look at that usually. But one of the things I look at is like to look for a company that has recurring revenues, and that's either contractual recurring or recurring in nature. So just to give an example, as a business that everybody knows that's recurring revenues is like Coca-Cola. Coca-Cola, once you drink it, it's gone. You have to go and buy another one to drink some more. And so people always get thirsty. They're not going to stop getting thirsty. And whether they choose Coke or not, that's a different question. But usually if you're going to drink soda, you're going to drink either Coke or Pepsi. And I mean, to me, Coke is a great business still. I know it's not growing, but again, like when I look at a quality of a business, I like to find something that has that recurring nature in it. The second question I always ask is do I like the people running it, and do they have skin in the game? And so that for me, I always try to find someone. I used to have a jewelry business myself and ran that, and I know what it's like from the inside operating a business. And so when I look at another business, I like to make sure that the people running it are running it, the way I think it should be run to some degree, and that they're running it really well, and they have the systems and tools in place to continue running it well. And then the third question I always look for is this valuation. I want to make sure that I'm buying the company's shares at a cheap enough price that I think logically and realistically will move up in value based off of some quantitative valuation method.
So I think that's one of the main themes for this episode of the podcast is valuation, and how do you come to that whatever it is, that number or that one metric, so that you can make that decision. So I guess this kind of leads into my next question. How then, in your opinion, what is a quality microcap company?
So a quality microcap company to me is there's a few factors that really matter to me. I mentioned recurring revenue, so I won't really talk more about that. The one thing I also like to look for is the stickiness in the business. How much would it cost someone to switch to a competitor in that business? To me, that's an important way to measure, whether a microcap company is quality or not. I don't like to invest in commodity businesses that it's very easy to switch between one business versus another business's products, because then essentially everyone is pricing to the dumbest competitor in the room. And if you have 100 competitors, you're bound to find one that's going to charge below their actual cost of pricing. So the example I like to give is if I used to sell jewelry, and I can sell you gold, and you would probably buy gold all day long if I priced it below what the market value of gold was. And so when I look at quality, I try to find businesses that have pricing power, and that's usually because there's not much competition, or if there is, there's stickiness to the product. So again, like Coke and Pepsi, as an example again, Coke can charge more for their product because you know what you're getting when you're buying a can of Coke. It's going to taste the same pretty much forever. Pepsi the same way. They've built that brand equity into the business. You're not going to go get the generic brand cola from your local grocery store instead, because it's not worth that extra 50 cents you're going to save per can or whatever it is, to potentially miss out on that taste that you came to expect from Coke. And so that's something I look for in the business. So again, that's stickiness and lack of competition. And then I also, again, management is very important. And it's not just management in terms of whether I think they're smart or whether they own a lot of shares and have skin in the game, but what have they done culturally in the company? Do employees that work for them, do they like working for them? One of the things that I do for every investment that we make is I visit every company. I try to go to trade shows of all the companies that we potentially will make investments in. I like to talk to the competitors, suppliers, customers, to make sure that what I think about the business actually holds true. Like Is there stickiness in their product? Does the business offer a good value to the customer? And so those are like the main things that I look for when I look for a quality of a business.
So then, after you put all of that stuff together, I mean, now we're talking about timing. So then, how do you know when, for any of the companies that you're looking at, how do you know them when to buy, sell, or hold?
For me, that's probably the hardest question I think that anyone can ever answer. And I mean, for someone to tell you that they know how to time buying and selling stocks or anything similar to that matter in a fluid market, I think is either lying to themselves or lying to you. But I mean, there's obviously certain strategies that I like to look for. I like to buy stocks that are trading at low multiples, and it's usually low multiples of cash flow. I sometimes trade on revenue multiples, but I don't like to look at revenue multiples because I just don't trust them. I gave that example about buying and selling gold. I could grow a business's revenue by selling gold, below market price all day long, but I'm losing money for that. So I don't like to look at revenue multiples generally. And so to buy, I like to buy when a business has had a hiccup because I think that people panic and emotionally people sell things irrationally much more than they buy irrationally. When a stock goes down, people start panicking and they kind of ride that snowball down the hill and continue exacerbating that panic and driving the stock down. I mean, it's very, very hard to catch a falling knife, but usually I like to look at businesses, and the best investments that I've made have been when companies may have made an acquisition that didn't pan out, or they miss their earnings estimates for some reason that it's more. I try to figure out whether it's one time in nature or whether it's actually a problem in the business or not. And so timing wise, again, if you pay a low multiple for a stock, it kind of to some degree protects you on the downside because, I mean, if you look at cash flow of a business, how much can that actually really drop in terms of the multiple you get for it? Mm-hmm. And so if I'm buying something at a 5 times EBITDA multiple, I mean, it can't really go too much lower than that. Versus if I'm buying something at a 20 times EBITDA multiple, it can very easily go down to a 8 to 10 time multiple very, very quickly if the market sees an issue with the company. And so that I like to look at that when I try to buy, and also I like to find a company that can potentially at least double within 2 years. And so I don't buy a company unless I think the stock can double at least within 2 years. So that's on the buy side. Holding, it's and with microcaps, another point I like to make is with microcaps, since a lot of them are very liquid, you can't buy a full position all at one time.
Right.
You kind of got to work your way into it, and I have check marks that I try to hit, or check posts that I try to hit as to what I need to do to build up a position. And so I'll build up to a certain size position, and then I'll speak with management on the phone, and then I'll build up even more after that. I'll go to trade shows and make company visits and do, as I get more and more comfortable with the research that I've done on a position, that's when I build during that time, and I build it out during that time. And so that, I mean, it can take some time. It can take like 6 months to a year for, on the long side in terms of building a position and buying shares of a company. And, and so that's on the actual execution side of it. And then usually I hold the shares for, ideally for less than 2 years until it doubles. And I build a financial model out where, it makes sense to me valuation-wise what can happen in a year or two. And based off that, I look at competitors in the industry or, a similar business and see what that trades at in terms of the EBITDA multiple. and I look 2 years out, and once I get to a similar valuation as those competitors, that's when I look to sell. Mm-hmm. And so if I sell a stock and it keeps running up afterwards, I'm okay with that because, in my opinion, it's already hit the value that I think the company is worth on a logical basis. And so sometimes you'll find companies that, they do really well and they'll double, and you know what, they may double again after that. But again, like I try to keep my sell discipline and sell when I think it's actually hit what I truly believe is the value of the company on a reasonable basis.
That's interesting because on the podcast, I would say most of our guests usually sell when something like fundamental about the company does change, whether it's like the messaging, the management, or the business model. So it's interesting that you come at it from a different approach. You don't care. Like even if it continues to go up, in your opinion, you have that strict discipline where you, in your head, okay, it hit this level, and even if it goes up, I have a realistic expectation that it's probably going to go back down, if not lower than the price that I sold it at. So I guess this is kind of a funny way to follow up to that. Has that ever really bit you in the butt?
Trying to think I try not to think about that because next time it happens, I'm in that situation. I'll be like, maybe I should hold on a little longer. So I mean, that example that I gave you was when things work out well.
Sure.
I do sell again when something does fundamentally change,
okay.
And it's usually more, did a competitor come into the industry? Did the industry dynamic in some way change? Or did I learn something new about the industry or the company that, I end up not liking, and it really raises a red flag? So, I mean, at that point, depending on how big of a red flag it is, you try to sell, immediately all the shares you can. Mm-hmm. But, I mean, in terms of that hitting me in the butt, we had an investment in Taser a long time ago, and I think after we sold there, I can't even tell you how many times I probably went up 30x afterwards. But again, the company ran way ahead of itself in terms of valuation. Yeah. And so I think it dropped down quite a bit after it ran up 30x. And, when it comes to buying and selling, I know I can never call the bottom, and I know I can never call the top. And I think that the key is just to be realistic in understanding that. And at times taking advantage of it, because if you have conviction in a company and you think it's really good, I actually, especially when I'm building my position, I actually like the fact that it's getting cheaper, and if it goes down and it gets less expensive in price, because not only am I decreasing the amount of risk in the company, because if I'm buying a company at a cheaper price, that's essentially less that I could potentially lose. But again, I'm probably getting more than a double that once it gets cheaper, because the price has gotten cheaper. So now my upside is much higher, in my opinion. So,
So what I want to know, just to follow up on that real quick, is, how do you know a company has gotten way ahead of itself in terms of valuation? Like you had your estimate where it's going to hit this, and but then, as you said, with that one company, it went up 30x. Like, how does that happen, and what does that mean?
So I like to look at cash flows again, and so when it runs ahead of itself, it's basing off of the current business performance. Mm-hmm. What they have to do to actually get a decent multiple on the stock for their cash flow, a decent cash flow multiple versus what the stock is valued at. Mm-hmm. So if a company is valued at, let's say, $200 million, and they're doing like $5 million a year in EBITDA, mm-hmm. like I don't want to pay that much for the company. I don't want to pay 40 times for the company. Mm-hmm. And so, yeah, to me, like it has to grow a good amount to get to that valuation, like a logical valuation. So, I mean, again, the EBITDA to me doesn't make any sense. The valuation compared to the cash flow doesn't make any sense, unless, like, they've publicly announced that they have, the deals in place or contracts in place to be able to, increase their EBITDA quite substantially. I don't want to have to pay. I don't want to have to pay for that risk of that growth mm-hmm. for the valuation. And so for me, again, when I see something that's, it's already doubled, and I don't see that amount of growth, and there's way too many risks between, the current cash flow versus what, potential future cash flow needs to be to support that valuation, that's what I consider it running ahead of itself.
Okay.
So maybe to say that a little bit more clearly is if a company is doing $5 million in EBITDA today, and they're projecting out in 2 years that it's going to be doing $50 million in EBITDA. If I don't see the connection very clearly between 5 and 50, and the enterprise value of the stock is trading on a multiple of that doesn't make sense, of the $5 million, it doesn't make sense, I'm happy getting out of it, because I'm not willing to pay for the risk of that growth actually happening or not.
Mm-hmm. So, actually, I did have another question regarding how do you assess a quality business model, but I feel like you kind of went over that a little bit earlier. And I kind of want to get to my next question, because that actually, I think, really ties into this idea of valuation. And it's something that we haven't really covered yet on the podcast. And it's a term, the term was that you create these financial models. So what I want to know is what is that exactly, and why is that important when you're doing your due diligence?
Okay, so a financial model is when you open up a company's K or Q, they always start off with a balance sheet, income statement, statement of cash flows. And so when I create a financial model, I go back and take the history of all those financial statements, and put that into Excel, and try to project out at least 2 years, the next 2 years, into what I think those statements should or could look like. And so a lot of it is all those statements, they talk to each other, accounting is its own language. And so a financial model is essentially my projections and a way to link all those statements together to look out 2-3 years. And the way I try to do that is a little bit differently is I try to break down each component into subcomponents. So revenues, I try to break down, for example, what makes up revenues of a company. It's the quantity of how many items they sell times the price of each item. So on MicroCaps, it becomes a little easier to do because companies don't have a ton of different products. And so I try to break it down into those components. The costs, again, whatever the company gives you, I try to break it down into, understanding what the costs are. What costs go into the business? Is it employee headcount? Is there operational leverage in the business? And that helps me, again, if revenues can grow and you have a lot of operational leverage in the business, you should have a better margin, and your cost of goods should be less than what revenues grow as a ratio. Mm-hmm. And so that's the type of work that I do, at least on the income statement side of building a financial model.
Mm-hmm. And why do you think? When you're projecting it out, like, do you have an algorithm or not an algorithm, but like some kind of equation that you plug into your Excel that will then give you the realistic number that you think it will be at, 1 or 2 years from the time that you're calculating all those numbers?
I wouldn't say it's an equation. It's very company specific.
Mm-hmm.
So you have to look at each line and see, what do you think is going to happen, or how is that going to change over time. So you have to. This is where it comes down to work of making sure you read all the press releases, on all of the Q's and K's of the companies you make investments in. I look at the management discussion and analysis section, where they give commentary as to why did revenues grow over last year, or why did revenue shrink over last year. And then companies that do the quarterly conference calls, I go over those transcripts, or I re-listen to them, and take notes. And I use that information to update the models and try to figure out my projections, my own personal projections as to what I think the company can do. And so I try to look at other drivers, like maybe it's a population, based on population growth, a business grows, or maybe there's 10% demand historically for this business, and I'll price that in forward to see, what happens to the financials of the business if I, put in that driver to my model.
Mm-hmm. So I want to ask another question that actually is kind of based on what you said in your background is, this idea of a value investor. Now, I've read, the Ben Graham books and One Up on Wall Street. I'm on my second time reading it. And, I want to just kind of get a definition as to what exactly that is. And, why it also seems like it's kind of making a comeback of sorts. So, I want to know why this philosophy is kind of making this comeback.
Well, I think over long periods of time, the concept of value investing has outperformed growth investing. There's different ways that you can define what value is and what growth is. But if you look at, I think Fama French had a historical study. He had a historical study that was done, I forget, 15, 20 years ago that they won the Nobel Prize for. And, he showed that over long periods of time, small in value outperform large in growth. And so, naturally, that somewhat does make sense because, once you're big, it's hard to get bigger. It's much easier to get big when you're small. You're nimble. You can adapt to changes much quicker. And when you're big, really the only way you can get bigger is through acquisition. So inherently, there's natural catalysts as to performing as a small business versus a large business. And then in terms of growth versus value, I think, again, there's a saying of hopes and dreams can last a very, very long time. And so I think emotionally, people, when you pay for something, you think you get what you pay for in terms of, an expensive item. When we go to luxury retailers and we buy, a Gucci wallet or something of that sort, you trust that, you're paying a lot of money to get something that's of good quality. And, a lot of times when you pay that money, the question is it worth what you paid or not? If you try to go and resell that immediately right away, you've probably lost a good amount of value there. And so as a value investor, when you're paying what you think is a cheap price, usually there's not much lower the price can go. And so inherently, I believe that reduces your risk on an investment when you pay on the surface a cheap price. And so there's a professor at Columbia who wrote the magic formula. I think the Magic Book of Investing is what it's called, by Joel Greenblatt. And he only looks with this formula at cheap PE stocks, cheap return on invested capital, or EV to EBITDA stocks. And a lot of these stocks, when you look at them, the companies usually have big issues, or they're in an industry that has big issues. And so, most people really hate on them, and the stock prices get incredibly cheap. But if one little thing doesn't turn out, if one thing turns out to be not as what people had expected, the stock can easily double or triple after that. And so, part of it is that no one likes to invest in businesses that aren't sexy, aren't cool, aren't the next new thing that's going to be such a big sensation. And so when it comes to value, people overlook the steady, simple companies that someone like Warren Buffett likes to invest in. So I think people see, at the end of the day, it's all about performance, and it's all about how well you can do as an investor. And I think as people research investing, they realize that value investing is really the best way to go.
So in your investing career, and this is my favorite question, what experience did you learn from the most that to this day you will never forget and you always carry with you?
Well, I'll say in my career in general, the experience I learned the most from was running my own business. From the inside, when you have to touch and feel every part of the business, from accounting to marketing to operations like fulfillment. I don't think there's any better experience than to actually, be in the shoes of doing that. In my investing career, the experience I learned the most from was, let's think, for me, it's company visits. I mean, and trade shows. I can't point to one experience that I've learned a lot from.
Well, like, here, let me phrase it differently. How about maybe like that one experience where you went to that trade show or you went to visit the company and you expected, and you or not even, you didn't have any expectations, and you went in with like, okay, I'm here to do my due diligence, and you saw something that you were like, holy moly, like either on the good side or the bad side, like that made you realize like, okay, for the next time I go on this visit or the next time I go to this trade show, I'm going to ask this question, or I'm going to, talk to this person. Do you got one of those?
Yeah, so I haven't had too many holy moly experiences from a visit. In a trade show, it's usually just getting a bunch of information from different sources to kind of verify if something's going on with a certain business or with a company. Mm-hmm. But, I mean, I'd say the experience generally of investing that I've learned the most from is we had an investment in a solid-state drive company, and this company, solid-state drives, there's like a handful of people who make them. Mm-hmm. And it was more on the valuation side. It was trading at a revenue multiple. The company never generated cash, and I just realized from that investment, and I lost a lot of money on that investment, that I couldn't project out, what they could do. I couldn't project out adoption rates. It was a new technology. It is a new technology, somewhat still, and the pricing, I couldn't decide. As technology improves, the pricing of the product comes down, but then adoption should go up as pricing comes down as well too. Mm. And so I could never get comfortable with understanding the valuation there, and that turned out to be a bad investment. So
that's usually
I'd say that was the best important lesson that I learned from my investing career.
I was just gonna say we usually learn the most from our biggest losers for sure.
Yeah.
So all right. What then is, on that bright note, hold on, what is your advice for new microcap investors that, based on everything that you said?
For new microcap investors, there's a slight path that I would take. My advice, first word of advice would be read as much as possible. And it's not just read, books about investing, but also, make sure you read the newspaper every day, follow up on that. But also make sure you read the details of, companies' 10Ks and Qs and different press releases that they put out. Those are really important documents to read. And also, don't just read things, but Howard Marks has a great book called The Most Important Thing. And that's one of the first books that I would highly recommend reading to a new microcap investor. Mm-hmm. But he always says that, when you read an article or you read something, there's always an inherent bias towards everything that's being written. And so you always need to kind of look past that, and the best way to make money is to kind of understand, what that bias is, and, where are people wrong. And so I don't know if you've ever been involved in any news article that was written about you or about something that you knew that you were very close to, but when you read a reporter write about it, you read it, and then afterwards you're kind of like, that's kind of what happened in reality, but it's not really what happened. In reality, this actually happened. And so when you read, it's important to take that, especially when you read the news, it's important to take that into consideration. And that's one thing that I would give to a new microcap investor is to I would read Howard Marks' book, and I would make sure I read everything I can in terms of the details of a company.
And where can our audience go and find more information about you and Grand Slam Asset Management?
To find information about me, you can, go to Twitter and, follow me on Twitter, SNN.Namiri, or you can go to our website, gslamcap.com. That's G as in George, and then the word slamcap.com, to find more information. And, yeah.
And that's at SNNAMIRI, correct?
Yeah.
Okay.
Yep.
Sam, thank you so much for coming on the podcast. I really do appreciate it.
No problem. Thanks for having me.
Thank you all for tuning into the Planet MicroCap Podcast, and thank you, Sam, again for coming on to the program. You can access the podcast by going on to stocknewsnow.com under podcast, go to podbean.com and search Planet MicroCap Podcast, or on iTunes and search Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap Podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@stocknewsnow.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of StockNewsNow.com, the official microcap news source, and the MicroCap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap Podcast. Have a great week, everyone.